Good afternoon. This is John Yeager with another episode of Think Business. Today I have a couple of great guests, and we're going to talk about a really interesting topic around deal flow, merger activity in the QSR space. My two guests are Vijay Vaswani and Cory Bennett. Vijay, welcome to the show.
Thanks for having me, John.
Can you give the audience a little background on you and what your role is at Bennett Thrasher and a little bit of background?
Sure, happy to. So again, this is Vijay Vaswani. I'm a partner at Bennett Thrasher. I lead the firm's transaction advisory services practice. Predominantly, transaction advisory services is a three-pronged service approach for our clients. It's financial, tax, and valuation services. From a service delivery standpoint, I spend the majority of my time doing buy-side and sell-side financial due diligence engagements, often coin quality of earnings analyses, for strategic buyers and sellers, as well as private equity investors.
Awesome. Thank you. And Cory, welcome back.
Thanks, John. Good to see you again. For those that may have missed the earlier episode, my name is Cory Bennett. I'm a partner in our FR&A, financial reporting and assurance practice. Also the co-lead of our restaurant hospitality industry group here at the firm. My core business of what I do is focus on compliance type audit work, both on the review financial statement audits, 401k audits, but also spend a good bit of my time on the M&A side, supporting Vijay in his role, as well as just bringing some more detailed industry experience to the table. So that's what we do, and together we work quite well and quite often in this current environment that we find ourselves. So I look forward to sharing a little insight today.
Awesome, fantastic. Well, I'm excited about the topic today. Obviously, the world has changed quite a bit. It used to look one way, and now it looks completely different. And so I know that's affected the M&A activity in the marketplace, especially in the QSR marketplace. So Vijay, I'm going to start with you. Can you give us some background into what's happening in the market, where it was, where it's going, and then maybe some thoughts about where it might be in the future?
Sure, yeah, John, that's good question, and obviously a hot topic on a lot of folks' minds, given everything that's going on in the current climate. So I'd say, pre-COVID, so we're talking March 2020 and prior, we were pretty evenly split in terms of mix of deal flow, pretty even keel in terms of buy versus sell side transactions, and even so in terms of strategic versus private equity clientele. I'd say there's been a bit of a tectonic shift since March of last year, in the sense that we experienced a little bit of a slowdown for about a 4 to 8 week cycle, and then picked back up significantly, but really doing a lot more work on the buy side, and specifically for private equity clients, right? Private equity, specifically those folks that may have just recently gone through a capital raise and just launched a new fund, were essentially equipped to deploy capital and take advantage of the opportunities that were out there in the market. So we started seeing a lot more private equity money kind of coming into works in the lower middle market. It took a while before strategics seemed to come back, but again, a lot of those were also opportunistic plays, right? They're not necessarily looking for companies that were financially depressed per se, but financially stretched might be the right vernacular. And so, finding opportunities to kind of, take advantage of being able to be in a larger platform, pull certain levers that will allow them to kind of, monetize the investment. Sell side activity in general had been relatively slow for a good part of 2020. We started to see a pretty large uptick in the back part of 2020, and then now actually I'm seeing the mix kind of shift back to what it was pre-COVID, to where we're pretty even back on buy versus sell.
Gotcha. And what are you seeing kind of any kind of broad themes around what people are doing with the funds that are being bought? Is it mainly kind of swooping up other stores, or are they making some capital investments? What do you kind of see is going on out there?
Yeah, I mean, it's interesting. I was looking back at our deal activity for 2020, and I don't know if I saw a ton of activity in the QSR space. Cory, you might have some color to add there, but where I saw people try to make play on investment opportunities were, like real estate's a really good example, right? Like a lot of these QSRs have real estate that's owned, and they aren't able to in a vacuum necessarily monetize that asset, whereas a strategic investor that's got the capital might say, okay, well, this is actually a nice play for us, we can get in here, it's a tuck in for a larger platform that we have, or an opportunity to create a platform. And look, there's these pieces of real estate here that we can potentially do a sale leaseback transaction or something of that sort, and instantaneously accrete value to our LPs from a return of capital standpoint. So those are some of the angles that I had seen in 2020. Cory, I don't know if you got any other color there.
Yeah, no, good context, Vijay. It's been a whirlwind. It's kind of a good way to describe it. Pre-COVID, in the QSR space in particular, it's always been, I guess, probably within the past 3 to 4 years, private equity's been very interested in QSR. They like the cash flows. They like the ability to roll up, underperforming units, other underperforming franchises, really kind of gather around a core operator that can really help them kind of, immediately add value to an existing portfolio. And so we were doing a lot of that work. And so all the way up to really March, we saw a lot of deals that were being done that way. And valuations were high, and particularly, strong brands. Yum comes to mind as one that, really saw a lot of activity and, really trading very high. So that we saw a lot of deals in that space, a lot of, private equity roll up various opportunities within that context all across the US, and we were very much involved in some of that activity. Post-COVID, I didn't know what to think, honestly. Fortunately for QSR, out of all the restaurant segments, they were one that really didn't see that big of an impact. And I thought that was very, very good. And so as a result of that, the M&A activity really rebounded kind of quickly. I thought we may not see a lot of deals in 2020 as a result of COVID, but boy, was I wrong. I think there was a lot of just really continued pent-up demand, I guess, from private equity, really wanting to continue deals. I had several that were on the cusp of closing and then really got relaunched within a couple of months after COVID, because again, the stores came back. They could see that it was a viable model, with the drive-through, and then you throw in delivery as well in the same context. It really created some value for those existing stores. So really saw some things come back a lot quicker than I thought, which I wasn't expecting, and it was a very welcome surprise. And then in addition, I think too, just heading into late 2020, a lot of sellers really accelerated some transactions as a result of just uncertainty with cap gain rates and things going forward in the new political environment. I think private equity in particular saw that as an opportunity to really close some deals and close some deals quickly and maybe a little bit cheaper than they would under a normal type situation. So we were very busy on our end, really got busy on the M&A side, as Vijay can attest to, and really saw a lot of activity close right around the end of December. I think you had a lot of financing that was available, not necessarily through traditional bank, but PPP helped, some clients that, really had a little bit of, powder there that was sitting there that they could invest. Main Street lending program was also another avenue that we saw some clients take advantage of and use that to their benefit to continue with some growth and expansion across the system. And then, as Vijay mentioned, just private equity and money's cheap, and really just putting money to work. We saw a lot of that as well. One thing I didn't know or was uncertain about is just valuations. What impact would COVID have on valuations, and would we see things trade a little bit cheaper, or maybe deals that were in some sort of development pre-COVID, would they try to retrade on the back end, trying to get some cheaper valuations? And I really didn't see that. I'll kick it over to Vijay in a second regarding just multiples, but to some extent, I think they held their own in this QSR space, and maybe even trended a little bit higher because again, thinking that, this particular space really wasn't impacted as much as they thought by the pandemic. And just given the growth in food delivery and other sectors, really seeing this as a viable option going forward. Real estate, obviously, something to consider with these deals as well. But really, just from a free cash flow perspective, so I think a lot of people saw this space as very attractive. Again, there were certain brands that were really being targeted. You saw some really big deals in this space with, Dunkin' Donuts is a good example that closed, post COVID, and there again is another reason that that particular segment is one that's very attractive in the market. So, as we look to 2021, I don't know what's going to happen. I don't have the crystal ball, but at the same time, I do think that you'll continue to see interest in this space. I think with rates where they are, I think you're still going to see some deals go. Valuations, I think for the most part, should in the near term stay relatively consistent. And so very excited about what we're seeing. We're seeing some big, large systems start to kind of deleverage a little bit and, maybe refranchise to some extent. I know we've seen a couple of those in some larger brands recently. Vijay mentioned, and that was a good point about the strategic side. We're starting to see some larger franchisees also, I mentioned earlier, sell off, but you've got some that are continuing to grow and expand and take that model going forward. So there's just a lot of activity is a good way to sum it up. But I would love to kick it over to Vijay just regarding just valuation and maybe outlook. Vijay, what are your thoughts as we step into this new year?
Yeah, no, that's fair, Cory. So I'd say, I definitely echo your comment that valuations tend to be creeping up. I don't know if it's more of a competitive dynamic of what's actually available versus, there just being too much capital out there to deploy in the current climate. But I'd say it all kind of comes back full circle to us from a financial due diligence standpoint, right? So a lot of times people will price a deal based on a multiple of EBITDA, and ultimately the diligence has to kind of prove out whether that EBITDA holds water, if you will. And so you think about certain things that are typical in the QSR space in terms of what you do in a diligence cycle, right? Obviously trying to understand the profitability of stores and locations, and transaction volume and price per ticket, and same store sales and margins, and CapEx needed to stand up new locations, startup costs, et cetera, right? Versus run rate costs, how long it takes for you to hit your maturity clip. All those things still hold water in terms of our analysis, but the dynamic kind of shifting back to what John had asked about COVID, it's definitely added another layer of complexity. Cory, you hit on some of that with the PPP element, right? Like, are people, having furloughs, or people being laid off? Are they taking PPP funds? Is that forgivable? How does that impact, how are those being reported in their financials, and how does that impact potentially earnings if it's going through the P&L? Elements like are they getting any rent abatements because of certain dynamics in the market, and are they negotiating other vendor payables, extensions on those type of things, getting reprieves, offering margin concession, things like that. I think all of that kind of comes into play when we're looking at doing a quality of earnings exercise or a financial due diligence exercise, and ultimately either validating that investment thesis for our client or disproving it. And if it is validating it, it's great. I mean, we usually give our clients our thumbs up to move forward and proceed with the transaction swiftly. And when it doesn't, we try to hit pause and say, okay, well, given these dynamics, what are we looking at in terms of, are we repricing this deal? Are we walking away from this deal altogether? Structures come up a good bit. Cory, I don't know if you've seen that on some of your transactions that you've worked on, but just given that a lot of companies have been impacted by their run rate performance has been impacted by COVID, right? And so historically, people tend to say, okay, well, if you have a temporary store closure or something of that sort, well, I see what the historical run rate is, so I can kind of use that as a benchmark to kind of go forward, right? That's not necessarily true in this current climate, right? Like there's a new norm in terms of what a post-COVID environment kind of looks like, right? And so there's some of that guesswork that goes into the deal process, and I don't think anyone necessarily has a ton of clarity as to what that looks like post-transaction. So I'm seeing a lot of people kind of include things like earnouts in their transactions to kind of allow enough time to lapse so we can establish that new norm.
Yeah, no, I agree, Vijay. I'm seeing a lot of that, and a lot of the deals that kind of closed right after COVID, a lot of them traded off of 2019, right? Because 2020 was such a volatile year, and really not knowing, one, there's so much uncertainty, I guess, with all the things that you covered, Vijay, and all the volatility that in the P&Ls during that time across the board. So it was good to kind of now that we've had a few months go by, I think more people are trying to really understand what is the new normal, what is it going to look like, what is that, what are those future cash flows going to look like going forward. And so I think that's where services like what we provide, it can really add value, is to kind of help trend that data and really come up with here is the sustainable cash flow going forward in this new environment. This is what we're seeing, this is what the same store sales are producing. And it may be different than 2019, or it may be the same. And so, again, really making sure that you understand that and communicate that well as part of a sell process is very important, to try to drive the value as high as you can under that scenario, and something that we're very, very good at doing.
So that's such good information. It sounds like we could probably talk for another hour or so about this stuff, for probably even longer. But I'm gonna cut us off right now. I'd love to revisit this with you guys maybe in about a quarter, just to kind of see how the market is reacting and see what's going on then. So I think that'd be a lot of fun and interest to our viewers. So wrapping it up, Vijay, you have any last minute thoughts that you want to add, and also how can people reach you and those kind of good details?
Yeah, sure. No, I'd say, we like I mentioned earlier, we do a ton of work with private equity investors and strategic buyers as well. We're pretty used to the type of rigor that diligence process entails, and so we're happy to assist clients on that front. But flipping that on its head as well, because we're used to seeing what buyers are looking for, we're certainly also equipped to help sellers kind of get ready for a process like that as well. Just kind of like, hey, these are the type of things that a sponsor might be looking for, or a strategic in a larger platform might be looking for. So here's how you kind of prepare yourself for a process like that. And so of course, any of those type of situations that come up, would love to chat about it further.
Awesome. And how can people reach you?
Yeah, sure. You can reach me via my email. It's vijay.vaswani@btcpa.net. That's not.com.
Gotcha. Awesome. And Cory, how about you?
Yeah, no, I just want to echo what Vijay said exactly. I think, one great service that we offer is just readiness. You've got a lot of, franchisees that are out there that see this as an opportunity to potentially, market and sell their business, but a lot of them do it too early and they're not ready, and that hurts value, and it makes the process a lot longer. And so, hiring a firm like Bennett Thrasher to come in, who knows the business, who understands the value that franchises bring, and just kind of do a cursory review of the books, get it ready, tee it up, do a sell side report potentially, especially if your company isn't audited or reviewed. There's an opportunity to add some value, if you will, to those statements and to that cash flow. And we've seen it be well received in the market, with us dealing with the type of buyers that we deal with. So again, just wanted to give you some facts and kind of a little lay of the land as we currently see it. But look forward to staying connected, John, through this particular blog, and hopefully we'll continue to see a lot of deal activity going forward. But once again, my name is Cory Bennett, and you can reach me at cory.bennett@btcpa.net.
Great. Thanks. Vijay, Cory, really thanks a lot. This was great info. I'm sure that the audience will appreciate this. And I think there'll be a lot of opportunities to work with clients. So this is the end of Know to Think Business episode. You can reach me at john.yeager@btcpa.net and at John Yeager. And all information will be provided in the video as well. So everybody have a great day, and we will talk to you in the next episode.